Folks, let me tell you what we saw on the night of Thursday, June 12, 2025, was a classic case of a geopolitical thunderbolt striking a calm market. The trading day had ended on a positive note, with investors feeling pretty good about things. We had seen cooler than expected inflation reports earlier in the week, with both the producer price index and consumer price index showing that price pressures were easing. This had everyone thinking that maybe, just maybe, the coast was clear for more gains. The market was humming along, looking to lock in its third straight week of wins, but as we all know, the market never sleeps, and neither does global conflict. This is a textbook example of how quickly things can change. The bombshell dropped when news broke that Israel had launched an airstrike against Iran. Immediately the calm was shattered. Israel's defense minister, Israel Katz, didn't mince words, declaring a special state of emergency. This wasn't some minor skirmish. This was a significant escalation in a region that's a powder keg for the global economy. US officials were quick to state that America had no involvement, but in today's interconnected world, that doesn't stop the ripple effects. The market hates uncertainty more than anything, and this event injected a massive dose of it directly into the veins of Wall Street. The fear gauge went through the roof, and investors who were feeling optimistic just hours before were suddenly running for the hills. This kind of event is what I call a black swan for your portfolio, an unforeseen and impactful development that sends carefully laid plans into a tailspin. We were cruising, feeling confident. The S&P 500 was less than 2% away from its all-time high set back in February. Think about that. We were on the cusp of a major milestone, fueled by decent economic data and a sense of stability. Then in the blink of an eye, the entire narrative shifted from economic fundamentals to geopolitical fear. This is why diversification is not just a suggestion, it's a commandment. You never know when a headline from halfway around the world will come for your profits. The psychological impact cannot be overstated. Investors who went to bed thinking about potential gains woke up to a sea of red in the futures market. This is the brutal reality of investing. It's not just about earnings reports and PE ratios, it's about war, peace, and politics. The suddenness of the Israeli strike served as a stark reminder that global events hold immense power over our financial markets. All the positive momentum we had built up during the week, with the Dow, S&P 500, and Nasdaq all on track for solid gains, was put in serious jeopardy. The game board was completely reset overnight. Now let's get down to the brass tacks, the numbers. Because when the talking is done, the numbers tell the real story. The reaction in the overnight futures market was swift and brutal, a real gut punch. Dow Jones Industrial Average futures plummeted a staggering 677 points, a drop of about 1.6%. That's a huge move for the futures market and a clear signal of panic. The S&P 500 futures, which give us a broader look at the market, tumbled even more, falling 1.7%. And for the tech-heavy Nasdaq 100, the pain was just as severe, with futures losing 1.8%. These aren't just small adjustments. This is a full-blown flight to safety. But the story doesn't end with stocks. Where did that money go? A lot of it went straight into oil. The second this news hit the wires, oil prices went ballistic. Brent crude, the international benchmark, surged over 7%. West Texas Intermediate crude, the US benchmark, also jumped by 7%. This is a classic fear trade. Why? Because the Strait of Hormuz, a critical choke point for global oil supply, is right in the middle of this conflict zone. Any disruption there could squeeze supply and send energy prices soaring, which is terrible news for consumers and most businesses. This spike in oil prices adds another layer of worry, threatening to reignite the inflation we thought was cooling down. What makes this downturn so painful is the contrast with where we were just hours before. On Thursday, the market had closed with quiet confidence. The Dow and Nasdaq both ticked up by 0.2%, and the S&P 500 added nearly 0.4%. We were building a solid foundation for another positive week. All three major indices were on track for their third consecutive weekly gain. This wasn't a market that was showing signs of weakness, it was a market that was climbing a wall of worry and winning. That's what makes this geopolitical shock so jarring. It came out of nowhere and completely derailed the positive trajectory we were on. The investor sentiment data tells a fascinating story of this whiplash. Just before the strike, the American Association of Individual Investors survey showed that bearish sentiment, the percentage of investors feeling pessimistic, had fallen to its lowest level since January 22 at just 33.6%. Meanwhile, bullishness was at a 3-week high of 36.7%. People were feeling good. Neutral sentiment was the highest it had been since the S&P 500 hit its record high in February. This data paints a picture of an investment community that was getting comfortable, perhaps too comfortable, right before the rug was pulled out from under them. In any market turmoil, there are always winners and losers, and this situation is no different. You have to know where to look. The most obvious winner, hands down, was the energy sector. While the broader market was bleeding, energy stocks were poised to rocket higher. This is a direct result of that 7% surge in crude oil prices. Higher oil prices mean bigger profits for companies that pull the black gold out of the ground. Before this crisis, the energy sector was already leading the S&P 500 for the week, with a solid 3.9% gain. Companies like ConocoPhillips, which was already up 8.6%, and Halliburton up 7.1% were sitting pretty. This event just added more fuel to their fire. On the flip side, the industrial sector was getting hammered. This sector is particularly sensitive to economic jitters and rising costs. Think about the airlines, for instance. For them, jet fuel is one of their biggest expenses. When crude oil prices spike by over 7% overnight, that's a direct hit to their bottom line. It's no surprise that United Airlines was already one of the top decliners for the week, down 8% even before this latest news. An escalation in the Middle East only makes their situation worse, not just because of fuel costs, but also due to potential disruptions to international travel routes and decreased consumer confidence. Let's dig deeper into the pain. Companies like GE Aerospace, another industrial giant, were also feeling the heat, down 6.1% for the week. These are bellwether companies that often reflect the health of the global economy. When they stumble, it signals a broader concern about economic activity. The fear is that a wider conflict could disrupt supply chains, increase transportation costs, and cause businesses and consumers to pull back on spending. This is why the industrial sector, which had been the worst performing S&P 500 sector for the week, with a 0.7% loss, was set to fall even further. It's a classic risk-off move. So, the playbook for investors in this environment becomes very clear. Money flows out of cyclical and growth-oriented sectors that depend on global stability and low costs, like industrials and technology, and it flows into safe havens and commodities. Energy stocks become a defensive play against the very conflict that is causing the market panic. It's a brutal rotation, but an understandable one. Investors are shedding risk and seeking shelter in the few places that can benefit from the chaos. Understanding this sector dynamic is absolutely critical to protecting your portfolio when a crisis hits. You can't just own everything, you have to know what to own and when. So, where do we go from here? The market is now in a holding pattern, completely at the mercy of headlines coming out of the Middle East. Every investor, from the big Wall Street pros to the individual at home, will be glued to their screens, waiting for the next development. Will Iran retaliate? Will other nations get involved? Will diplomats manage to de-escalate the situation? These are the questions that will dictate market moves in the coming days and weeks. The focus has shifted entirely away from the economic data that was driving us just a day ago. The market is now trading on fear, and that makes it incredibly volatile and unpredictable. Beyond the immediate geopolitical crisis, investors will also be keeping a close eye on what this means for economic policy. A sustained spike in oil prices could force the Federal Reserve's hand on inflation. The cool CPI and PPI reports gave us hope, but soaring energy costs could erase that progress. Furthermore, we have to watch the political landscape here at home. Just before this crisis, Treasury Secretary Scott Bessent had hinted at extending a tariff pause. However, President Trump also signaled potential unilateral tariffs on countries like Japan and South Korea. Trade policy uncertainty is the last thing the market needs right now, and this conflict could complicate those negotiations significantly. Investors are also hungry for any new data that can give them a sense of how the American consumer is feeling. The next big report on the docket is the preliminary June reading of the University of Michigan's Consumer Sentiment Survey. This will be the first major piece of economic data released since the airstrike. Will consumers be spooked by the international turmoil and rising gas prices? A sharp drop in consumer sentiment could signal that a pullback in spending is coming, which would be another blow to the economy and the stock market. We need the consumer to stay strong, and this report will be a crucial test of their resilience. Ultimately, the path forward is shrouded in fog. The bullish case from just a few days ago, cooling inflation, a resilient economy, and strong corporate earnings, has been shoved to the back seat. The bearish case, geopolitical conflict, soaring energy prices, and renewed inflation fears, is now firmly in the driver's seat. Investors need to be nimble and cautious. This is not the time to make big, heroic bets. It's a time to review your holdings, ensure you are diversified, and prepare for more volatility. The market has been dealt a tough hand, and how the players react in the coming days will set the tone for the rest of the summer. Booyah!